Hello and welcome everyone to our latest webinar presentation where we'll be having Dominique Dwor-Frecaut talking about her Fed view. Just for background, my name is Bilal Hafiz. I'm the CEO of Hive. And Hive, for those of you who don't know, is one of the leading research providers for all levels of investors. And just to give you a flavor of the type of investment analysis and insights you can get, let me just share our website screen to show the types of things you can get. So we have one product which is geared towards individual investors. So if you're an investor who kind of cares about your personal portfolio, cares about macro, this is the right product for you. Here's the website, and you see the types of articles we have. We have some macro, so we have a Fed preview here. We look at some extreme market moves. So for example, over here, we publish this on Mondays. We look at which markets have experienced the largest moves over the past week. Recently, over the last week, it was essentially 2-year Swedish swap yields and also Chinese 2-year yields. And at the other end, it was the Chinese renminbi. So this allows you to get a sense of where are the extreme moves happening. Then on top of that, we also have videos. So every weekend, we publish our week ahead views through videos where Dominique goes through things to look out for the weeks ahead. And earlier this year, we launched this wildly popular explainer series where we get people in our team to explain key concepts in markets. So for example, Dominique recently wrote a piece on the Fed balance sheet, how it works and what quantitative tightening means and how it transmits itself through the balance sheet, what is money, credit, and so on. We have an explainer on what duration and convexity is in the bond markets, what is proof of stake, everything you need to know about fertilizer prices. And then we also have some fun stuff. We have our podcast series over here. And through that, we basically get our podcast guest book recommendations. So if you're ever looking for a book to read, just go to the books section of Hive, and this will all have books that our guests have recommended that have influenced them. So it's a great selection of books. And I often go here to find the next book I should be reading. And then also we have my blog. I write this every Friday where I just go through sort of random topics. So this is about women in the workplace. This is about what is gravity. This is wisdom from the ancients, different traditions. And so, this is kind of all you need to live a wealthy life and spiritually a healthy life as well. But now back to the topic at hand. I should also, before I forget, before I get told off by my partner here, let me also show how you should access some of the content. So if you're not already a member, which I'm sure you all are, but if you're not, you can just simply go to the website. This is the non-logged on site. Just go to subscribe and you can just sign up for a free newsletter here. If you sign up here, you'll get the free newsletter, which will give you some level of content. And then if you're more serious, you can then go to the paid subscription, which has a lot more content. And then if you're a professional, so if you're an asset manager, hedge fund, then we have a whole separate product, which has much more in-depth research, Bloomberg chats, regular calls. You can get to speak to Dominique whenever you want, for example, and things like that. But back to the webinar at hand. And the reason for doing this webinar was that Dominique, who is our US economist, I should also give her credentials. Dominique used to work for Bridgewater. She used to work for the New York Fed, the IMF, the World Bank. So she has all the accolades that you need to be a good economist. But recently, she put out a view that she thinks the Fed could end up hiking rates to around 8%. So while other banks and other analysts are talking about 4% as the peak terminal rate, Dominique has for a while now put out a view on 8%. I was quite shocked by her views, and many of you in the audience have been as well. So hence we set up this webinar, and she has a quite compelling case for this. So what we'll do now is we'll kick off the webinar. And so I'll just hand it over to Dominique. She'll give a short presentation, maybe around 20 minutes or so, and then people can ask questions. So the way you do that is there's a Q&A box on the Zoom window. Just put in your questions, and then I'll curate them towards the end and fire them off to Dominique. I've got a bunch of questions I also want to ask her as well. So Dominique, welcome to the webinar. You need to unmute.
Typical.
One day.
Thank you, Bilal, and also thank you, everybody, for listening. I hope you will come back with a lot of pushback. This is what's most helpful to me. But I mean, in a nutshell, why at 8%? 3 reasons. Number one, inflation is high and persistent. Maybe Bilal, you can put the slides.
Okay, yeah, sure.
Up the first one. So 3 reasons. Inflation is high and persistent. The Fed inflation framework is flawed. And the historical experience shows that in order to bring down inflation, the Fed needs to close the gap with the Taylor rule Fed funds. So let's first talk about inflation. That's high and persistent. I know that the Fed has been saying for some time this is we are at peak inflation now. Year-on-year inflation is going to slow because of base effect. Fair enough, but base effect only lasts for so long. I think eventually, if we stay at the month-on-month inflation prints we've had, we'll stay in the neighborhood of where we are with inflation. And that's what I want to argue, that whatever improvement we are likely to see are likely to prove transitory. And, economists are not complicated people. They break down things between supply and demand. And so let me just do that and look at the supply side. Okay, for sure, we've had an improvement in core inflation last month, core CPI, big decline in second-hand car prices. However, longer-term picture doesn't look that great. 2 reasons. Number one, the war, excuse me, the invasion of the Ukraine is another supply shock, not just in terms of oil, in other energy products, grains, fertilizer, but in terms of disruption of global supply chains, like Ukraine used to produce neon gas, which is needed to produce chips. Also, ships with a Russian flag can no longer use global ports and or at least ports within the US and its allies. So second supply shock. And then not to mention China's zero COVID policy, which is not going to change because for Xi Jinping, it's a way of asserting his control ahead of a Congress of the party where, he will get his mandate extended. So second supply shock. And then if you look at wages, the picture is not great either. And this is what I'm showing on the right-hand side on this page. If you look at core services inflation and wages using the Fed preferred wage measure, the two are virtually indistinguishable. And as you know, the last measure of wages, we got surprised on the upside, 1.4% Q-on-Q from 1% in Q4. So on both accounts, it doesn't look like supply is going to improve much over the medium term. And then demand is not as steady as people think. If we can move to the next slide, please. There are a couple of things I want to show you. So for instance, fiscal policy. The consensus view is that there is fiscal consolidation going on. And no question, on the left-hand side, I'm showing you the budget balance in percent of GDP. And you can see that between 2020 and 2022, there is a shrinkage of the deficit of about 10 percentage points of GDP. However, if you look at the cyclically adjusted fiscal balance, which is the orange line, the reduction in the deficit is only half as much. And why look at the cyclically adjusted budget balance? The idea is that the impact of your deficit is different if unemployment is, say, 3%, than if your unemployment is, say, 10%. So that's why you cyclically adjust the balance to take into account the extent of resource slack in the economy. And so this is exactly what I'm showing you on the right-hand side, on the scatter plot. The relationship between the budget balance and unemployment. And in blue, you have 40 years of that relationship, basically from the 70s to the pandemic. And in those 40 years, I've colored in gray the dots that correspond to the GFC, the Great Financial Crisis. And you can see that fiscal policy was in line with what was done before during those years. But look at the orange dots, which is fiscal policy and unemployment during the pandemic. I mean, the extent of fiscal stimulus was just enormous. And by the way, I suspect a lot of that had to do with the fact that it happened during an election year. And what's happened is that because the stimulus that was put in the economy was so enormous, there was a super fast recovery in the labor market, and unemployment is now, below the CBO estimates of long-term unemployment. But fiscal policy has adjusted much more slowly. So the bottom line here is that, contrary to common perception, fiscal policy, given where we are in the cycle, is actually still very accommodative. Next slide, please. The other thing that I want to talk about is credit, and credit to the household sector. Those of you who follow my work know that I used to be very optimistic about inflation. I thought it would, fold by itself, largely because I expected the switch we had during the pandemic from services to goods consumption, especially durable goods consumption, that played a big role in the surge in inflation. I expected that switch to revert itself. But I think I've been proven wrong by the data. If you look at the orange line on the left-hand side, so this is a real consumption, broken down between durables, non-durable services. Durable is the orange line. You can see that, it's declining, but not that much, still remains much above trend. So I'm thinking there could be two things going on there. First of all, we've had long-term changes in consumption patterns. Like, for instance, people are going to continue to work from home, a good number of us. And that could mean that they need more durable, more computers, more terminals. They will be consuming fewer services. So that's one. The change in the pattern of consumption could be more permanent than I thought. And the other thing that is going on, and that I think is super, super important, and we're just starting to see it, and if you go on the right-hand side, is a pickup in household credits outside of mortgages. Obviously, there is a big increase in mortgage credit linked to the housing market that is still on fire. But even outside of mortgage credit, you can see that credit is picking up. So first of all, and I would add that this chart on credit is in percent of GDP, not in dollar. If it was in dollars, the increase of the blue line of the last point would be stronger, and the orange line, which is basically total credit, would actually be going up, not down. But what I'm trying to show you here is that households that had been deleveraging since the GFC basically have a lot of capacity to lever again, and that this is starting to happen. Those two lines, so the blue line is basically non-mortgage credit from banks, where it's a bit more timely than the orange line that is total non-mortgage credit to households, so from banks and non-banks. Unfortunately, it comes out with a lag. But what you see is a pickup, and that is consistent with anecdotal evidence. And I certainly don't base my analysis on anecdotal evidence, but as you know, there is a bit of a trade-off between the quality and the timeliness of the data. And so very often, before you see data in the macro number, you see them anecdotically. So through the newspaper, for instance, there's been quite a few stories about household borrowing picking up. And I suspect this is going to give a second wind to the US economy, especially since it is 70% consumption. Now, one last point about inflation, something I've been beating my drum about for quite some time, is corporate pricing power. And I think that's a big difference between now and the 1970s. The US economy is much more concentrated than it was. And so you can see that on the left-hand side. I'm showing you again nominal wages, headline inflation, and you can see that prices have increased by more than wages, which I think is a reflection of this corporate pricing power. And you can also see it on the left-hand side, where I'm showing you the share of profit and wages in income. And it's absolutely fascinating. You can see that the share of profit is actually at a historical high after all the shocks we've had. And to me, this simply reflects the strength of corporate pricing power. And one last point, about the persistence of inflation. The Fed often talks about the wage price spiral, but I'm not sure it's a little bit of a chicken and egg problem, in the sense that when there is inflation, when prices go up, nominal wages have to go up. Otherwise people won't show up to work. So one tends to bring up the other. And even though, in our case, prices have increased by more than wages, what is important, I think, to get out of this is the persistence, that because of this feedback loop, inflation tends to be persistent, and inflation at 8.5% is a lot more difficult to bring down, a lot more costly in terms of employment and output losses to bring down than inflation at, say, 3.5%. Okay, so that's my first point. Inflation is high and persistent. Now, let me explain to you why I think the Fed inflation model has been falsified by the data. The Fed inflation model consists of two things: the expectation augmented Phillips curve and the natural rate. So let me deal first with the expectation augmented Phillips curve. So there is this very famous speech, or at least famous for economist nerds like myself, this very famous speech by Yellen, Inflation Dynamics and Monetary Policy, where she explains what is the expectation augmented Phillips curve. And it's basically, the idea is very simple, is that you have a long-term inflation trend that is driven by long-term inflation expectations. So you have the blue line, which is, I've put in the University of Michigan expectations, but there are many survey-based expectations out there. And the deviation from the idea is the deviation from the trend caused by supply shock, whether it's a weaker dollar, higher commodity prices. These expectations don't matter. The shock to inflation these shocks don't matter. They don't have a persistent effect on inflation as long as expectations remain well anchored. And in my view, this model has been completely falsified by the data. It's very simple. Look at where University of Michigan long-term expectations of inflation are back to where they were in 2014. On that same chart, I'm also showing you the Fed own index of inflation expectations that includes survey-based, but also market-based, so B, market-based expectations of inflation. And same thing, inflation expectations are back to where they were in 2014, when inflation was well below the 2%. So inflation expectations are stable, but look at where inflation is. And I've used core PCE because this is the most advantageous data to the Fed. It's only a tad above 5%, but if I had used, headline CPI, inflation would be 8.5%. I think, at some point, the Fed and the rest of us need to look at this model and say, it's just not working. It's not explaining what is happening here. And to be fair to the Fed, some of them agree with me. There is a senior Fed economist last year who published a very interesting paper where he basically argued that inflation expectations had no empirical or analytical basis, that it could not be observed, that it was just a convenient way of economists to have models that made sense, but were not reflective of what is going on in the real world. And one of my jokes is that the only people in America who care about inflation 5 to 10 years down the road are the respondents to the University of Michigan survey. So it's a little bit of a quip. This Fed economist has done a very in-depth job of, demonstrating that it's very dangerous to have policy based on something that is only very loosely defined and that you cannot observe. So that's my first stab at the Fed inflation model. My second stab is about R star, the natural rate of unemployment. I'm basically, I think this concept, again, has no analytical or empirical basis. And it's not just me saying this, but a long line of much more distinguished economists than myself. So, the Fed defines R star as a unique interest rate that balances savings and investment, which is basically a modern version of a very old idea that has been around, since the 1920s, which is a loanable fund theory, that savings equal investment. And the problem with this theory is that it's inconsistent. I mean, investment in reality is equal funding, i.e. money and credit. It's not equal to savings. Savings is a national account. It's just a part of output that has not been consumed. And the other problem, and by the way, as I said, this is what the BIS is saying now, but this is also what economists in Cambridge, UK, had been arguing through the 50s, 60s, and 70s, and also a criticism that Keynes made in the 1930s. So the concept, just like expectations of inflation, it's a very loosely defined concept. And then if you look at how it's estimated, estimates of R star that we get are not based on, let's test for the existence of R star. the estimates that typically we get from central bank are, since R star exists, let's try to compute its value. And there is a bit of circularity here, because central bankers will tell you that rising inflation implies that R is below R star. But not really testing for the existence of R star. And the BIS did some very serious empirical work, and they found that the low R star reflects actually central banks pursuing very loose policies since the Volcker disinflation. That basically you had very low and stable inflation below target, which was driven by structural factors. Central banks felt they had to push inflation to 2%. Their success was, I'd argue they were not very successful, but the one thing they did manage to do is to push their estimates of R star to a low level. And the BIS argues that during periods of, actually they don't argue, but they show with their work that during periods of tighter policies, so for instance, the gold standard period, long-term real rates were actually much higher than they are here. So the bottom line here, in my view, is that central bankers have been lucky until now there wasn't an inflation shock big enough to really test their view. And now that we are getting this inflation shock, in my view, it shows that their model is flawed, and their estimate, which means that their estimate of the terminal rate is well below where it needs to be. So let me turn to that now. Okay, this, a joke, is my killer chart. But basically, this is what made me think of the 8% as or close to 8% terminal rates. So what this chart shows is the actual Fed funds and a Taylor rule Fed funds, which I have computed in the simplest possible way, basically using central banks' own estimates of R star, which is basically, I think, an estimate of real trend growth. Plus the deviation of inflation and unemployment from their long-term value using equal coefficients. So there is no data trick here. It's the most simplistic Taylor rule you can think of. And the thing that really struck me is how tightening cycles work. I mean, basically, the Fed starts tightening when the gap between the Taylor rule and the actual Fed funds is high, and they stop tightening when the gap is closed or nearly closed. And if you look at the last data point on the picture, especially the gray line, which shows the gap, you can see that the gap is the largest since the first oil shock. And the current value of the Taylor rule is about 7.5%. So it varies, obviously. When I first produced this chart, it was about 8%. So, you know, that's why I'm saying close to 8%. Obviously, if once we get there, we will be in a different universe. So I don't want to be falsely precise. The bottom line is that you cannot expect a terminal rate of 2.8%, which is what we have in the March SCP, to bring down 8.5% inflation, to bring it down to 2% makes no sense. And I think once you let go of the Fed model of inflation, so once you let go of the expectation augmented Phillips curve, once you let go of R star, once you give up on those beliefs, actually, I'd argue that my 8.5%, my 8% terminal rate is not so fancy. Next slide, please. So just one more comment here about the Fed strategy to bring down inflation. This table is showing you every tightening cycle since the mid-1960s. And one thing it shows you is the change in the Taylor rule during the tightening cycle. And what you can see is that in every row of that table, the Taylor rule change, which is the last column on the right, is positive. So in other words, when during the tightening cycle, the target rate, or the terminal rate, keeps rising. And that makes sense because when you think about it, you start tightening because there is an imbalance in the economy represented by the gap between Taylor rule and actual Fed funds. And this imbalance takes time to get resolved. And that's why the Taylor rule is a little bit of a moving target. It moves away from you. But the really interesting data point on the table is the top row last column, which is the Taylor rule change implied by the SCP. And you can see it is negative. So in other words, the Fed is thinking that unlike all preceding tightening cycle, they will benefit from disinflation from non-monetary causes. And I would argue, based on everything we've discussed so far, the high and persistent inflation, the flawed model of inflation is not going to happen. So that's another reason for my close to 8% call. And I would argue that the market is turning my way. First of all, there are more and more people who have started to revise their call for the terminal Fed funds, maybe not close to 8%, but to 5 to 6%. So that there was a big supplement in The Economist a week or so ago. Maybe you saw it. There are banks. I saw that there was an interview of Rogoff. So there is a sense that the terminal rate the Fed is looking at is just not likely given what inflation is at. And then in terms of markets, this chart is showing you the 5-year B and the 2-year 1 month forward OIS swap. And so what we have basically is long-term B breaking the range of the past 5 years, while expectations of the policy rate are basically the highest they've been since the GFC. So to me, this is saying that the Fed is losing confidence, the market is losing confidence that the Fed will be able to stabilize inflation with its current policy framework. And so how is this going to play out? Next slide, please. I think for now, the Fed is sticking to its knitting. Basically, a change of model or a recognition that the model is flawed is not going to happen unless we get incontrovertible evidence that this is not working. So what I suspect is going to happen is that, right now we have 3 meetings where the market is pricing 50 basis points. I think inflation is going to remain high. And what's going to happen is that beyond these meetings, the market is going to continue to price 50 basis points. The Fed is too scared to push back. So they'll do 50 basis points. We'll end up the year around with the Fed funds above 300 basis points and probably core inflation, depending on what measure you use, but I would think core PC closer to 5% than 4%, and not slowing. And at that point, and while we do that, the curve will invert the curve will first steepen because the market will lose confidence in the Fed ability to stabilize inflation. And when we get to the point of Fed funds 300 basis points and more above, and core inflation high and not slowing, I think this is when the Fed capitulates and they go for a terminal rate close to my estimates, and we have massive inversion of the curve, and this is when we have a recession, which I expect next year. Now, I know this is quite, it's not the consensus, obviously, but I would argue that there is a precedent, which is the second oil shock, that basically the Fed was reluctant to hike because of rising unemployment. But as I show you on the right-hand side, eventually they capitulated, they tightened policy, let the Fed funds go to 20%, obviously not my forecast, but the point here is that you can delay the inevitable only for so long, and that the political pressure to bring inflation under control is only going to get stronger. And so eventually the Fed will do what's needed, and what's needed, unfortunately, entails a recession. And that's the last thing I'd like to share with you. This table shows the cost of stabilizing inflation. And basically, if you let me go through the columns one by one. The first column gives you the start date of the tightening cycle. The second column gives you an estimate of the imbalance in the economy, measured by the gap between Taylor rule and actual Fed funds. And then if you go to the third column from the right, it gives you a sense of the output cost of stabilizing inflation. So the number of quarters that was needed to close the output gap caused by the tightening cycle. And you can see that when the imbalance is large, for instance, look at the first row, look at the second and third row from the bottom of the table, the number of quarters to close the output gap or to close the unemployment gap was very large. It was not very large in my first tightening cycle for a very simple reason. The Fed didn't have the guts to stabilize inflation. It remained at 3%, which explains why in 72 and 77 the gap was so big. But the bottom line here, it's very simple. The more you delay, the more painful it gets. Okay, so let's talk a bit about the market implications. So obviously, the Fed funds is underpriced, and not just the 2022 or 2023, but I think the market sees the Fed cutting in late 2023. I just don't see it likely at all. I fear this is going to be very painful for everybody. As I said, the Fed, sticking to its current framework, and the market losing confidence in the framework suggests curve steepening. Eventually, the Fed capitulates, raises the terminal Fed funds massively, and that's where we get a really big inversion of the curve. Obviously, different central banks have different ideas on this, so we could see a comeback of FX volatility. So, one possible way of playing my scenario would be to be long dollar against EM carries. That's one possibility. Also, high inflation is bad for both bonds and stocks. So Bilal has those trades, short SPX, short Euro stocks, short bonds. That's obviously a medium-term view. As you know, there is right now, the market is pricing a 50% probability of a 75 basis point hike in June. I think Powell is going to push back on Wednesday. And if that is the case, we could have a relief rally. But look at the big picture. It's high and persistent inflation, and that's just not good for financial assets. And the other thing that I thought was interesting is that, one implication of the BIS quantitative work on what drives the long-term real rates is that if all central banks start tightening at the same time, we could have an increase in real rates. So the increase in real rates we've seen could have further to go, which obviously is not great for commodities, except commodity like oil, where we have a supply issue linked to geopolitical developments. So this is what I have to say. Thank you for listening to me, and I hope you have many questions.
Great. Thank you very much, Dominique. A very sort of comprehensive presentation there. And I noticed you had a lot of information on each of the slides. So if anybody wants to get hold of that presentation, just message someone in the MacroHive team. You can message me at Bilal@macrohive.com on Twitter, DM me or Bloomberg or whatever, and I can send you the slide pack. It's well worth sort of studying. So Dominique, just before we go to the Q&A, there's a bunch of questions people have already started to pose. Just if I understand this correctly, so there's two components to your view here of this very high Fed terminal rate. One is on the fundamental side, so what's going on in the economy. Your view is that inflation's going to be more persistent and higher and stickier than many people think, and that is due to the consumer durable side holding up more than you and many other people thought, the fiscal side not being as bad in terms of the drag, credit picking up as well. So all of those kind of factors sort of keeping inflation high. Then thrown to the mix, the more structural aspect, which is that corporate pricing power still is very strong, so they can afford to kind of keep prices high. Then the second part is your belief is that the Fed reaction function is changing now because the Fed's model that they had of how inflation process works, which is this expectations augmented Phillips curve, so expectations and some kind of R-star framework, that just hasn't worked at all. So if you then fall back onto a Taylor rule, which is kind of more of a stripped down version of what the central bank should do, that suggests a much higher policy rate, in the 7-8% or ballpark. So is that a fair sort of characterization of your view?
Absolutely.
Okay, great. So, in relation to all of this, we've got a bunch of questions. One asked directly about the Taylor rule, which is that, and this is Reece Simons, if you followed the Taylor rule for the post-GFC period, Fed funds would have been 3 to 4%. And surely this would have produced even more anemic growth than we actually got over the last 10 years.
So I am a very, very big critique of QE. I actually don't think that QE and low long-term rates did much for the economy. I think that it did enormous amounts of good to financial market, but there was much less of a transmission to the real economy. And in terms of the specific question on, I'm not saying that on whether we should have stuck to the Taylor rule, right? If you look at my picture, you can see that the Fed closes the gap in a very gradual manner. I mean, monetary policy is an art, not a science. So I'm not arguing for sticking to the Taylor rule all the time. I'm definitely, given the shock to balance sheets that we've had, there was a need to keep the policy stance looser than the Taylor rule. But I would argue that we would have had much less financial asset price inflation if we had stuck to the Taylor rule, and without making much of a difference to the recovery, because what slowed the recovery was really the decline, the balance sheet repair by household, and it needed to take place. And for sure, you didn't want positive real interest rates, but I don't think you had to keep those super low interest rates for that long.
And we've had like a whole barrage of questions, which are kind of asking the same question, which is around can you hike with the high level of debt that we currently have? So, for example, one person, Stefan's asking, I understand the need for higher rates. However, rise in Fed funds would risk driving up the budget deficits. Leverage is higher than the 70s. Do you think that's realistic given the level of public sector debt? Don't you think that a Japanese style outcome, capping yields, is more likely? So basically, does everything change when your level of debt is so high? So can you roll over debt? Can you manage?
So for sure, a truly independent monetary policy is going to impose a tighter budget constraint on the government than automatic monetary financing of the deficit. So if we go to where I think we are going, we will be in a different universe. And I think, and that's one of the reasons to expect a recession, the government will likely be forced to implement real fiscal consolidation because, I'm thinking of a sharply inverted curve, but still, it's very valid to say that interest rate costs will go up. But I would say this is not Japan. Clearly, look at where inflation is in Japan. Look at where inflation is in the US. There are structural factors that apply to Japan and don't apply to the US. So demographics, for instance, is not as bad in the US as it is in Japan. I also think that in Japan, one big driver of low inflation is proximity to China, because trade. There is a lot of trade with China. It's a gravity theory of international trade that you trade more with countries that you are geographically close to. And I suspect Chinese deflation, which is endemic because of their huge investment, because capacity production keep expanding in China. I suspect this gets transmitted to Japan, and the US is not impacted by that to the same extent as Japan. So I think the political pressure to bring inflation down in the US is what is going to force the Fed to step up. And just some word on the backdrop of political pressure. So I spend a lot of time listening to testimonies of power in Congress, and the relationship between GOP senator and power has become much frostier lately because of the Fed inability to stabilize inflation. And the Republican head or the ranking Republican member of the Senate Banking Committee has suggested some reforms of the Fed, which in my view make perfect sense and should have been done 30 years ago. For instance, rationalizing the system of Federal Reserve Bank, because we have two regional federal banks in Missouri, one in St. Louis, one in Kansas City, and only one west of the Rockies. San Francisco Fed covers the whole West Coast. Subjecting the appointment of a regional Fed president to congressional approval, all those things make change, but bureaucrats don't like change. They don't want to be basically reorganized by Congress. And these ideas that Senator Toomey put forward are getting a lot of traction. And I think that pressure from Congress is going to be a big incentive for the Fed to get its act together and bring inflation under control.
Okay, no, that's great. And then there's a few questions just around the modeling side of things. So one person, Reese here, the Michigan survey might not be useful. So what about break-even inflation measures? Is this not a reliable measure of people's perceptions of what will happen to inflation? This says, if you look at the inflation curve, it says inflation will move down. So don't you believe investors are pricing it appropriately?
So break-even are pricing inflation expectations of people who buy and sell, tips and nominal bonds. I don't think they are pricing inflation expectation of the general public. And to be fair, ask anyone around you who is not working in markets, what is their expectations of inflation 5 to 10 years from now, and how has it influenced their purchases? And I bet you'll get a blank stare. My point here is that it's very dangerous for the Fed to have such faith in their model that basically they are expecting, as I said, immaculate disinflation. Maybe the market is right, maybe it's wrong, but you can't not do what's needed to bring down inflation because of what's happening to inflation curve. I would think it's very risky on the part of the policymaker. Okay,
yeah. Okay, we got another question about the framework. So this from Roberto from Peru, I guess. What about the Fed's changing its framework for conducting monetary policy? So they've gone from the 2% to the average inflation targeting. So if the framework has changed, maybe the Fed will try to avoid the long-term expected inflation, structurally breaking 3% and accept relatively high inflation for some time. And maybe that's what break-evens are telling you. So basically, how does this new framework affect things? Does it allow them to just accept higher inflation for a period of time?
So I think the acceptance of inflation is going to be driven by politics. And if you look at the polls right now, the number one preoccupation of American voters is inflation. So in my view, this average inflation targeting model trips the Fed is one additional reason why they missed the ball on inflation. And it shows that the Fed, they mean well, they all have PhD in economics, but they were in a way fighting the last war with this average inflation targeting, and they had overconfidence in their model. And so going forward, I am hoping that they won't stay wedded to this model because it's clearly been proven wrong. And I am thinking that the political pressure is only going to get stronger. So my answer to that question is that what is going to drive the Fed going forward is not so much their model, but the political pressure, which are only going to get stronger.
Okay, we've got like 5 minutes left, so I'll kind of give you a bunch of questions so you can maybe answer them a bit more succinctly so that we can squeeze more questions in. There was a couple of questions about commodities. So one question was how does high inflation impact commodity prices such as copper and aluminium, so the metals? So if high inflation, does it lead to lower or higher commodity prices? And then there's another question the other way around, which is, how does higher rates encourage more supply of commodities? Surely all that does is kill demand. You'll never encourage investment this way, and you'll have more permanent supply constraints. So the argument there is if this is a supply shock, then how does higher rates, how does that create more commodity supply?
Okay, so so I'll answer the second one first because it's the easiest. The Fed would say, and I agree with them for once, monetary policy cannot do anything about the supply side of the economy, but what it can do is bring the demand side more in line with the supply side. That's
okay, yeah. So there's been a shift in the supply curve, so you've got to move the shift to demand curve,
exactly,
to match that. Okay.
And the other question on high inflation, I mean, there is a long-term negative relationship between real rates and commodities like gold or commodities that are close to money, so which are more financialized, if you will, which makes sense because commodity do not generate any cash flow, so the opportunity cost of holding them is higher if you have the higher real rates are. That's how I would look at it. On the other hand, for commodities that are less financialized and where physical consumption, physical demand matters more. And I would argue that this is where we are with oil, that we are really in a situation where, because of the tightening sanctions on Russia, in effect, the supply of oil, the physical supply of oil on the global market is going to decrease. So that's why I think oil within the commodities universe is likely to be less sensitive to rising real rates.
And then we have a couple of sort of questions around the growth side of things, and we'll just end with those questions. So one, they're both kind of related to each other. One person asked, what's the impact of expectations of higher rates on employment and housing? And another related question is, how high do you think unemployment can get to in your 2023 recession scenario, and how that effect flows into passive and target date funds in the US and crossover into risk markets? So that flows into all the sort of passive equity funds. Are you calling for a major stock market crash in 23?
So the first one was, sorry, the first one was...
It was the impact of higher rates on unemployment and housing.
Okay, so so definitely through the funding, I mean, through financial conditions, high rates means that mortgage rates go higher, and so demand for housing goes down. But look at mortgage rates; they are 5%, above 5%. So, but it's still below inflation. We're talking about negative, if you take headline CPI as your measure of inflation, we're talking about negative 3.5% mortgage rate, when the appreciation in housing on average in the US is still close to 20% on annual. So this gives you a sense of how much more the Fed needs to tighten to bring the economy and to bring inflation under control. Okay, unemployment, we could have, I think, 6-7% unemployment is not impossible, because the Fed has really been postponing. The more they postpone, the bigger the imbalance, the bigger the need for tightening, and the nastier the shock to the economy, especially since, as someone mentioned earlier, the implication of a tighter monetary policy is going to be that the government will have to tighten its belt. So you'll get a double blow. And I would argue, by the way, that this is in a way payback for the excessive loosening of monetary and fiscal policy during the pandemic.
Great. Okay, I think just to keep to time, I'd like to thank Dominique for presenting and answering all of those questions. So thank you, Dominique. And then I'd also like to thank everyone who dialed in to the Zoom call to listen to all of this. It's great to have a big audience listen to these sorts of views. Then we hopefully will have a replay of this available. So if you want to let your colleagues and friends know about this, then we'll be sending out a link on email. And if you aren't already on our mailing lists, there's a free mailing list. If you just go to the website, subscribe, sign up to that, and then you'll get notifications like this. Otherwise, do sign up to become a member so you could hear Dominique's views more regularly. So once again, thank you, everybody. Thanks, Dominique, and good luck with the Fed tomorrow, and good luck investing for the year ahead.